Hi, this video about prime entry books. So I'm here focusing mainly on A-level students, A-level accounting students, but O-level students also can use this as their tutorial. So prime entry books, here we are discussing about prime entry book introduction and explain of each prime entry books and adjusted cash account and reconciliation statement, control accounts and subsidiaries both in debtors and creditors, and finally error corrections. This is a basic theory video, okay? I'm not discussing here any accounting activity, just only theory. And first of all, these are my two books that already published, Company Accounts and Cash Flow Statements. So each book have 25 questions and with the answer book as well. So you can answer that from your own and then check your answers. And also, if there are any cases, then you can watch my explanation videos because I am uploading all explanation videos for all these 50 questions as well in through my YouTube channel. So please, if you want to purchase, just send me a message through my WhatsApp so I can deliver any hometown in Sri Lanka. And also, please do share for your friends as well. Okay, so because you are my well. Move back to the prime entry book. So the prime entry book are the first place that you are recording your transactions at first, right? So prime entry books are the books in which the transaction of business are recorded at first after identifying through source documents. So you can't record any transactions without source document. So any transactions you have to identify through source document, and the first place that you are recording such transactions is prime entry books, right? And here actually the transactions are categorizing into the similar characteristics and recording to relevant primary books. That let's assume that we have the bowl of transactions. The transactions all are in your bowl. So when you are doing accounts, it's much easy if we are categorizing, if we are classifying these all transactions into similar characteristics. So that's what we are doing in private books. From those transactions, you are picking the all cash receipts and recording the cash receipt journal. All cash payments, you are recording the cash payment journal. So here, what we are doing here, we are categorizing the all transactions into similar characteristics uh, to easy the process of accounting, right? But keep in mind, in this case, you do not need any knowledge about double entry system. It's only the recording of those transactions in your similar characteristics. Okay. The importance of prime entry books. Similar types of transactions of a period need to be classified and recorded. Posting transactions to the ledger becomes systematical and convenient after recording in the prime entry books. Responsibility of preparing each prime entry book you can assume for the each department or each individual, right? So from that you can minimize the errors and frauds as well. It is easy to maintain the ledger because the total of prime entry books are posted to the ledger, so which minimize the number of entries posted. Because so let us assume that if we are recording all cash receipts and cash payments individually in your cash account would be like a road. It's very low because there are a lot of cash transactions. But here, what we are doing, all the cash receipts and cash payments we are recording in separate journals, and the total of those journals comes in cash control account, right? And minimize the occurrence of accounting errors, and it is easy to find out errors and actually as well as frauds, right? And yes, source documents. As I earlier said earlier, you can't record any transaction without source documents. So source documents, original documents are the documents that prove that transaction is already happened, already incurred, right? And these are source documents are the legal documents as well, right? As and when transaction take place in a business, the documents prepared by a particular section of a business, including all the details of transactions and authorized by a person in charge, are known as source documents. So source documents include these following cases, things, name and address of the business, serial number, the number of the document, the date of which the transaction had taken place, the details of the other party as well, and description of the transaction, the monetary value, and the signature of the authorized and who authorized who is responsible for that transaction. Uses of source documents can be used as an initial document for transaction. That's what we are doing here. You are identifying transactions through source document and recording your prime entry books, and can be used as a written evidence of the transaction. That's why I earlier mentioned these are the legal documents. In the court, this is accepted as the legal documents, and these are the proofs that a transaction is already happened, right? And additional information on the transaction can be obtained, can be used for recording transaction into the prime entry book. That's what we are obviously doing here. And the responsibility can be assigned to a specific officer as it authorized by that person. So in A levels, we have to not only the A levels, the whole journey in accounting, we have to identify 8 different prime entry books. Cash receipts, you are recording in cash receipt journal, and cash payments, you are recording in cash payment journal. So the source documents that you are identifying cash receipts are the receipt, and the payment voucher is the source document that are along with the cash payments. Apart from the main cash payments, if the firm is at whole, if the company is following the petty cash interest system, so the petty cash payments, you have to record in the separate journal, petty cash payment journal, and the source document is petty cash payment voucher. Credit purchases, purchase invoice, and purchase return debit note. So each one, purchase journal and purchase return journal. Cash sales. So here should be on each. It's not be cash sales. So I will correct that. This is credit sales. Credit sales we have to identify through sales invoice and then sales journal. Sales return, credit note, sales return journal, and the other transactions. So any transaction that you can't record in above source document or above prime entry books, that comes in general journal and identified through journal vouchers. Okay, so let's see of each prime entry book separately. First in cash receipt journal. So in this case, you are recording all the cash receipts that happened in the concerned accounting period of an organization. So here the cash receipts we are classifying through cash sales, data receipts, other income, and other receipts. And if this firm is registered for VAT, so there is a separate VAT column as well. Okay. So date, receipt number, description, discount allowed, and amount. Why this discount allowed happened here? Because you are giving a discount allowed when you are accepting cash from the debtors, right? So the same transactions happened in at once. So that's why the discount allowed may column in cash receipt journal. So the double entry cash control account should debit the totals of these analysis columns, and then that relevant account is credited. Cash payment journal. So all the cash payments that you identify through voucher, you have to record in cash receipt journal. And here also, as we did in cash receipt journal, we are classifying all cash payments into cash purchases, credit payments, other expenses, and other payments as well. And if it is VAT registered business, VAT registered firm, there is a separate column for VAT as well. So the double entry is relevant account debit, and the total of these you should credit to the cash control account. And the petty cash payment journal. So why the businesses are operating a petty cash payment journal if the business has a large scale payment? So to keep the unimportant, so which means less important and small amount of payments, you are keeping a you are having a petty cash interest system in a separate way. So the main cashier is here, petty cashier is here. So main cashier giving money to the petty cashier to spend for the month, and petty cashier is spending for those expenses from their own, right? But at the end, and starting from the new month, and the main cashier is reimbursed the interest amount. So what's that actually happen? Main cashier is reimbursed at the end of the month the amount that actually spent in that month, right? So let us assume that the petty cash interest is 25,000. So in Jan, the petty cash payment that happened 23,000. So at the end, there is 2,000 balance in your petty cash journal, right? And on the starting of the new month, the petty cash, so the main cashier is reimbursed the amount that spent to refill up to that petty cash interest 25,000. So the balance is 2,000, and their petty cash spent in last month 23,000. So that 23,000 is the exact amount the main cashier is reimbursed to the petty cashier, right? But sometimes the management can decide and increase the petty cash interest as well. Okay, so this is the uh, format, but in the O levels there is another thing here, is receipts. So in O levels, in our syllabus, it says the petty cash journal as an account as well, right? But in this case, this is only the journaling error, so there is no any receipt column in petty cash payment journal. And here the analysis you can record the analysis as your the analysis that are mostly suitable in your business nature, right? So the expenses you are recording in these analysis columns, and the non-cash expenses you have to record in ledger accounts. When you are paying the non-cash expenses like creditor payments and the small liability payments, you have to record on the ledger account, because those are not and expense payments. So those are the non-expense payments. So you have to record in ledger account, and when you are posting, you have to record that in that separate ledger account. And also there is a important expense that you can't record in analysis, but you are recording that in ledger account as well. What is that? Carriage inwards. Why we are doing that? Because there's a specific place in income statement to record carriage inwards. When you're finding the cost of sales, you have to add the carriage inwards after purchases, right? So because of that, carriage inwards you have to mention in a separate ledger account. So that's why the carriage inwards, when it comes to the petty cash, you are recording the ledger account separately. Bit hot here, you. And the sales journal. Here only we are recording the credit sales. So you have to identify credit sales from the sales invoice. And if it is a VAT registered business, there is a to another column, VAT and total. If not, just only amount. Okay. So the total you have to debit to the trade receivables, which mean debtors, and credit to the sales account. Purchase journal, here recording all the credit purchases. So the credit purchases, there is a two criteria that should fulfill. Those purchases should happen on credit. That is one condition. And the other condition is those purchases should intention of reselling. You should purchase those purchases on intention of reselling. So let us say that you are purchasing property, plant and equipment on credit. So property, plant and equipment you are purchasing to use in your business. Those credit purchases of property, plant and equipment you can record here in the purchase journal, right? Only the purchases that on intention of reselling and credit are comes under purchase journal. The double entry is purchases debit and the creditors credit, trade payables credit. Return inward. The customers that who brought the goods from us, they are returning back to the business. So there can be several reasons for that. The order is not matched, or the stock was damaged, or anything, right? And the double entry of that, return inward debit and trade receivables credit. So this the source document is credit note. Why? So when the credit sales happens, debtors debit. But returning what happened, that reverse. So what happened to the debtors? Debtors are credit. So that's why the source document is credit note, right? And the other important fact is this returning word is income type of account. So normal incomes has debit side, but this has normal income has credit side, but this has debit side. So which means the decreasement of the income. But keep in mind, return inward is a income type of account. And same thing, if it is a VAT registered, there is a two columns comes VAT and total. If not, just only the amount column. Return outward journal, same thing. Here we are sending back the stock that we purchased from our customers. Same reasons can be applies here as well. So the source document is a debit note, because when you are doing purchases on credit, it's incurring the creditors, so creditors debit, sorry, creditors credit. But when you are doing the return outward, it reverse. What happened to creditors? Creditors are debit. So that's why the debit note. Okay. And same thing, return outward is an expense type of account, but normally expenses are debit side, but this has credit side, so which means decreasement of that expense. So purchases decreasement, right? And same thing, if it is a VAT register, there's two columns, VAT and total. If not, just only the amount. And the general journal. So any transaction that you can't record in the above prime entry books that we discussed, we have to record in the general journal. The whole rubbish comes to the dustbin like that. Right? So all other transactions that can't record under above prime entry books, blah blah, comes here. So the examples for that: opening and closing entries, error corrections, adjustments, PP, credit sales, and the purchases of any transaction. So you have to record the double entry and the narration here. Okay. And that's it for the primary books. And this is also under primary books, adjusted cash account and bank reconciliation statement. Uh, this this subject criteria is also including the O levels as well, right? So here what happened, the cash account is prepared by the business. And when we are doing the transaction through a bank account, so the bank from their self, they are preparing the statement as well what happened with the account. So that statement is bank statement. So at the end of each month, the bank is sending us the bank statement by including the transaction that happened through our bank account, right? So the same transactions, you are recording the transaction that you are done with the bank through a cash account, and the bank is preparing and send us a bank statement, the same transaction that they recorded. But if we recorded the same transaction, so the balances should be equally. But because of these reasons, the bank, these cash account balance and the bank statement balance is not equal to each other. So what are those transactions? Direct remittances. So direct remittances mean the debtors and the other cash receipts are done through our bank directly. The debtors deposited cash to our bank directly. So it's recorded in the bank statement, but not recorded in the cash account because we do not know, right? But the actual thing is we do know because there is a message and he called us and tell Machang, I deposited money for your account. But why can't use at the exact point the transaction that happened? Because without a source document, we can't record. So the data deposited money, but there is no such a source document to use that in our books. But after you receiving the bank statement, then there is a source document, so you can use the bank statement as a source document, and they record that as in your cash account, in the adjusted cash account. That same theory applies for the standing orders and bank charges as well. So standing orders mean the expenses orders that we give to the business, so we give to the bank to transfer some amount for the exact account in every month or in fixed date, right? So that those standing orders are paid by the bank directly. But why you can't use that record in the cash account because the lack of the source document, bank charges as well, right? So all these three, we do know that it's actually happened at the exact point, but we can't record that in our cash account because without a source document, you can't record. But after you receive the bank statement and now you have a source document and using that the bank statement as a source document, then you can record in your adjusted cash account, right? That's what happened here. And also the dishonored checks as well, right? And after you recording all these errors and omissions that happen, and these things can adjust in your own because this cash account is prepared by the firm. So the cash account prepared by the firm also can adjusted by the firm, right? So the direct remittances, standing orders, bank charges, and dishonored check, we are adjusting through our adjusted cash account. But till the adjusted cash account balance is not tallying with the bank reconciliation statement. What's the reason for that? Issued but not presented. The checks issued but not presented, and the deposited but not realized. What is happening here? When we are issuing a check to any party, at the issuing date, we are crediting to a cash account. So let us say that I am giving a check for you. So at the exact point, I am crediting in my cash account. So we are in April, right? But after you receiving a check from me, you are not withdrawing or you are not transferring that check through my bank account for your bank account within April. That's the case. At the point that you are withdrawing cash or transferring to your bank from my check, at that point it is recording in the bank statement. But if you didn't do in April, so I recorded that in my cash account because I gave you a check in April, but you didn't go and withdraw transfer to your bank within April. So that not appeared in the bank statement. That is what we call issued but not present. That is not an error. That is not the error that the firm made or the customer made. That's not the error, and also the bank made, right? Deposited but not realized mean when we are receiving a check, we deposited, but sometimes it is not realized in a bank statement as well. So those two are not an error that anyone did, right? These are the things that happen with the time frame, right? Oh, so we are not adjusting these. But the above these things we can adjust to a cash account, but because these are the errors and the omissions, mostly these are the omissions, right? But these two not an error, not are the errors. So these two we are here the bank reconciliation statement. We are presenting, we are showcasing why the still adjusted cash account balance is not tallying with your bank statement balance. Here we are presenting the reasons for that. We are here not adjusting anything. We are just presenting why the reasons still the adjusted cash account balance is not tallying with your bank statement balance. Okay. Whew. Debtors control account and debtors subsidiary ledger. Okay. So the control account being when you have a lot of debtors, you can't record the separate account for each debtor in your general ledger. It's a very complex case. So all debtors we are recording only one account. We are maintaining only one account. So that is debtor control account. So this part in the double entries and the debtor control account, we are recording the debt in our main ledger, right? But you have to know the information what happened to that exact debtor in a separate way to each individual debtor. To record that, we are recording individual accounts for each debtor in a separate ledger, what we call subsidiary ledger, right? So in the debtor subsidiary ledger, we are maintaining an individual account for each debtor like this. So the main ledger have double entries. Debtors debit, then the other account credit. Debtors credit, then the other account debit, right? But when it's come to the subsidiary ledger, we are only recording the single entry that effectively affected only to the debtor. So let us say the credit sales. So in the main ledger, debtors debit, sales credit. We do the double entry. But in the subsidiary ledger, we are only recording the entry that relevant for the debtors. So debtors only debit. Why? If we do the double entry in the subsidiary ledger too, the sales are will be credited twice. So that's incorrect, right? So in the subsidiary ledger, only the single entry, but in the main ledger, double entry from the control account. Okay. So if you recorded the things correctly, so the debtor control account closing balance and the debtor's risk balance should be equal. But there are some reasons and it's not equal. Then you have to do the adjusted control account and reconciliation statements as well. Okay. Same thing comes to the creditors as well. In the main ledger, control account and the T accounts, the other journal entries as well. But in the subsidiary ledger, there is only single entries that relate to the creditors and individual account for each creditor. Okay, so these are the transactions and you are recording here. Okay. And the last one, error corrections. So accounting, the main idea is providing information. So we have to provide the correct, accurate information to the stakeholders to get their decisions. But sometimes the errors can be happened. So the errors when transactions are recorded in the prime entry books, the transactions are posted to ledger from the prime entry books, and when balancing of ledger accounts, when the trial balance is prepared. And apart from these, the frauds can happen. Someone can do the mistakes and errors intentionally to do some frauds like that. Okay. So error corrections, if you identify the errors that happened, so you have to correct the financial statement and then re-prepare it and repost it. You have to present the correct statement as always. Okay, so that is what we call here error corrections. So error corrections we can divide to two things: errors that do not affect the agreement of the trial balance and errors that affect the agreement of the trial balance. Do not, so first of all, what is trial balance mean? Trial balance mean the accounting process. You have to identify transactions and events to source documents, and then you are reporting the prime entry books, and then the total of prime entry books you are posting to the ledger accounts. And after all, at that point, the balances of ledger accounts you are recording in a separate statement. Trial balance. It's not a statement actually. It's like more about like what we call it for a summary, a summarization like that, right? So in the trial balance, we are recording all the balances in debit side and the credit side. So the debit and credit should be equal, right? But when the debit and credit equal happen, but there is still the errors that can be happen. So that's what we call here errors that do not affect the agreement of the trial balance. So why? If we debited some amount for if we debit some amount and if we credit the same amount to the credit, so the debit and credit should be equal, right? It will be matched, but the main principle can be wrong, right? The complete omissions of a transaction: no debit, no credit, trial balance equal. Recording incorrect value of transaction in the primary book. Incorrect value in the primary books mean the primary books total transactions we posted to the ledger. So if you done an error in the primary books, that affect to the both accounts, debit, credit, trial balance equal. Recording same transaction twice, debited twice, credited twice, trial balance equal. Recording the value of transaction in an incorrect account instead of the relevant account. You should debit to A account, but you debited to B account. Either way, you debited, credited, trial balance is equal, but still the errors, right? So when the errors that have do not affect the agreement of trial balance, you have to correct those two accounts, and that's not affecting to the suspense account. And here the errors that affect the agreement of the trial balance. Omissions of one entry. Only debit, no credit. Case. Trial balance is not equal. Making one of the double entries with the correct value. Correct value debit, wrong value credit. Trial balance is not equal. Recording of double entries of transaction in the same site. You should debit and credit, but instead of that, you debited for both accounts. Or you credited for the both accounts. Trial balance is not equal. Errors which arise when balancing of the accounts can be, and that's balancing cases that only fit to one account, and errors that arise when preparing a trial balance. So those errors are affecting to the agreement of the trial balance. So such errors, when you are correcting those such errors, there's a suspense account. So one in the affected account, you have debit or credit, and the other entry goes to the suspense account. Yes, so half hour we discussed the prime entry books. This is only I discussed the main basics theories that we should know. I have not discussed here any accounts theories, accounting activities, just only theory. Right? So please do share with your friends, and I publish the workbooks and all workbooks explanation videos. I will upload and uploaded already some transactions in through my YouTube channel, so you can practice from your own in your home. So if you want to purchase, just send me a message. So please do share And please do comments, compliments as well as complaints. Those both will motivate me, and that is the only satisfaction that I am getting from here, right? So please do share with your friends because you are my wealth. Okay, thank you. Until that, goodbye.